Hi, once again welcome to my channel. We have been discussing about the trading with RSI indicator or oscillator. In my first video, we have discussed about the how to identify the trend with the help of RSI oscillator or indicator. In second video, we have discussed about the divergence, trading with the divergence, identifying the how to identify the momentum continuations with help of RSI hidden divergence. And today we are discuss about the third advanced levels of RSI indicator, the RSI divergence, which can help us to identify the momentum continuation or reversal of the trend. So let's get started. RSI classic divergence, or it is also called a regular RSI divergence, is a signal of reversal trend from bearish to bullish, from bullish to bearish. As we have been discussing, I have shared you the video. Please do watch that video if you want to understand the RSI hidden divergence. Here, today we will be discussing about the regular divergence or classic divergence, which is a sign of reversal trend, whereas the hidden divergence will help us to identify the trend continuation. So, number one, classic divergence is a strong bullish divergence where we can find it when the price is making lower lows, when in the opposite of the direction, the RSI is making lower highs. And that is a strong sign of a reversal trend which can help us to move from bearish to the bullish side. So now let's look at the live example of chart. Here you can see that the price has met lower lows when in the opposite side the RSI is making lower highs, which indicates us to the trend will be reversing from bearish to the bullish side. So it is very strong reversal signal in the bullish side. So what you have to do is we have to find either we have to look for the chart pattern or the candlestick pattern. With combination with that, we can give a very good confirmation of the reversal trend. Here you can see the bearish candlestick. Suddenly a strong bullish candlestick is formed. Whenever this high of that bullish candlestick crosses, we can enter the trade by keeping the stop loss below the bearish candlestick pattern with 1 or 2 points buffer zone. So we can write with the strong trend upwards. Now, second type of bullish divergence, classic divergence, somewhat not that strong, but it's a medium term. That, how can we observe that? You see that price is making lower lows, equal lows, but whereas in the opposite side of the RSI oscillator, it is still making lower highs. So let's see the chart example. Here you see the market is in downtrend. Suddenly a double bottom was formed. We call it double bottom also or W pattern also. But the lows of the previous W is equal to the present W. So, but whereas the RSI indicator oscillator, it is indicating that RSI is developing lower highs. So whenever we can find a very strong bullish candle when it in follow-up candle crosses above of this bullish candle, we can enter into the trend and we can keep this stop loss with the buffer of 1 or 2 points below this swing group. So we can write a somewhat a good bullish reversal trade. Now third, the classic bullish divergence is somewhat a very weak divergence where the price is making lower lows, whereas the RSI makes the equal. So RSI indicator will help us to identify the strength of the market. If this trend is somewhat low, the market will also have a very low reversal trend. So here you can see the live example. The price is making lower lows while the RSI is making equal lows. And we can see the trend reversal from bearish to the bullish. Now on the other side, we will be looking under the classic or regular divergence of strong bearish divergence. And number one is that if the price makes higher highs, whereas in the opposite to the price, if the RSI oscillator is making higher lows, it is a strong sign of that trend might be reversal. With combination of with this classic divergence, bearish divergence, we have to look for the candlestick pattern. Here in this chart example, we can see the price is making higher highs, whereas the RSI is making higher lows, which indicates that it's a very strong sign for the reversal. So whenever we can find the candlestick pattern on that bearish side, here you can see one strong bullish candle comes, and in that way there is a small inside candlestick pattern is formed. So whenever this breaks, we can enter the trade with stop loss 1 or 2 points buffer zone above this inside candlestick. Now we can write a very strong term trade. The second bearish divergence, classic divergence, is somewhat a medium, not that strong, but still we can see the diversion or trend reversal. Here you see when the price makes equal highs, whereas in the opposite to the price, if the RSI is making higher lows, then it is sign of a reversal. We call it double top or M pattern. So we can write the tree with that on this. Now let's check the chart in the chart. Here you see the price has made equal highs, whereas the RSI is still making higher lows. So whenever the strong bullish candle is, we can see the bearish reversal candlestick pattern is formed. We can absorb and we can enter the trade just after closing that bearish reversal candlestick pattern and keep the stop loss above this candle with 1 or 2 buffer zones, and we can write the bearish trend downwards. Same way as the bullish, the third weakest bearish classic or regular divergence occurs when the price is making higher highs, whereas the RSI is making equal highs. So what we can do is it is a significant signal of that the trend might reversal at any time. Now in the chart where we can see that price is making higher highs, whereas the RSI is making equal highs. So whenever we see a strong bullish reversal candlestick pattern, when it crosses that low of that bearish candlestick pattern, we can enter the trade by keeping the stop loss above the 1 or 2 point above that bearish high of that bearish candle. So we can write the strong down trade. Always remember that the RSI indicator is just an indicator, but we have to make a combination with other tools like candlestick pattern, chart pattern, price action, and data in order to get almost 70 to 80% confirmation of the trade. Otherwise, the indicator might lead to false signals. So to avoid that, we have to first of all check the candlestick pattern. If you have not seen my video, please do watch that. We have discussed about the 5 reversal candlestick pattern for the bearish and bullish market. And other thing is we have to know the chart pattern, price action, and data. So that can give us more confidence in order to trade in the market. Plus, it will help us to make a profitable trade with higher accuracy. Thank you so much for watching my video. If you are not subscribed to my channel, please do subscribe and like the video if you find it is valuable. Thank you so much and have a wonderful day.